Hello, children. Hope all of you are very well. And because we are going to discuss today some important ratio and which is also related to companies' wellness. And that ratio of wellness is the profitability ratios. This ratio shows the profit earning capacity of the company, of the business. Okay. Now everyone know that why profit is important. It is required for expansion of the business. It is considered as the lifeblood of the business. It is the source of livelihood of the owner. So that's why it is very important for the owner as well as for the company's stakeholders to understand the profitability ratio of the company and to understand the future prospect of the company. Fine. So profitability ratios have been classified in these various types. The first one is your gross profit ratio. Second one is your net profit ratio. Third one is your operating ratio. Fourth one is your operating profit ratio. And last one is your return on investment ratio. So all this ratio we'll discuss. But today we will be discussing the gross profit ratio, the net profit ratio and the operating ratio. Okay, in this video I will be explaining you these three ratios of gross profit ratio, net profit ratio and operating ratio for the better understanding, and then later in the next video I will teach you the next remaining two ratios. Okay, so let's start with gross profit ratio first. Now what is gross profit ratio? Now everyone knows that what is the meaning of gross profit? The profit which is calculated before subtracting any indirect expenses. Means from gross profit, indirect expenses is not yet subtracted. That's why it is called gross profit. That means some more expenses are yet to be deducted. So the ratio analyzes the percentage of gross profit in sales. Means how much percentage of gross profit is there in the total sales of the company. Say if the sales is of rupees 100 and gross profit is of 20 rupees. Okay, just a minute. Say the sales is of rupees 100 and the gross profit is of rupees 20. So we can say that this is a percentage. 20% profit is there. And in another case, if I take that the gross profit of the company, say it is again 30 and the sales of the company is say 100. That means company is earning 30% gross profit. It means that in the second case, the percentage of GP is higher. That means company is earning more gross profit. Now, what's more gross profit means? Higher percentage shows lesser cost and increased sales. So it is better. So if the company's gross profit is higher, that means company is earning more and more profit by reducing its expenses. Which expenses? Especially the direct expenses. Okay, lesser direct expenses or lesser cost of production and increased sales. So that is the meaning of higher gross profit percentage. And one thing I forget to tell you, that all these ratios are expressed in percentages. Okay, because profit can be better understood through percentage. Okay, now coming to the next one. So the formula of gross profit ratio will be gross profit upon revenue from operation. It means sales into 100. Gross profit upon RFO into 100. Okay, so that is the formula of gross profit ratio. Let's take one example how to calculate gross profit ratio in this question. So the question has given you credit revenue from operation 3 lakh, cash revenue from operation which is 25% of total revenue from operation. That means we have to calculate what? Cash revenue from operation. Then purchases is given and excess of closing inventory over opening inventory is given. So according to the formula of gross profit ratio, first of all I want revenue from operation, which means what? Total sales. Now total sales will be calculated as. Now total sales, all of you know that total sales is equal to what? Total sales is equal to cash sales plus credit sales. Okay. So now in the question they have given you the credit revenue from operation, how much it is? 3 lakhs. So credit revenue is given, one part is given, credit revenue is given. Cash, for cash what they have given you? 25% of total revenue from operation. That means of total sales 25% is the cash sales. Now total sales is not given, so we will assume this to be X. Okay. So by putting this X we can calculate the value of RFO, that is total sales. See here. Now in the first step, we have to calculate total RFO. So total RFO is equal to what? Cash RFO plus credit RFO. Of that, credit RFO is given in the question 3 lakh and cash RFO is 25% of total RFO. Now total RFO is assumed to be X because it is not given, and 25% of total RFO X is 2500 or 25 upon 100 into X. So now solving this equation, we will calculate what? The value of RFO, that is 4 lakh. So the value of RFO comes to be rupees 4 lakh. Fine. So then again see this. So by putting the formula of total RFO, cash plus credit, we have calculated, and cash sales is what? Total 25% of total RFO. So by putting X as total RFO, we have calculated the value of X, which is 4 lakh rupees. Now the next stage, cost of goods sold. Why I am putting the formula of COGS? Because to calculate gross profit, I want COGS. Okay, because GP is equal to what? RFO minus COGS. So COGS is equal to opening stock plus purchase minus closing stock. Direct expense is not given, so that's why I have not written here direct expenses. So COGS not given. Purchases is given how much? See, purchase is given rupees 3,20,000. So purchase is given 3,20,000. Now the next one is your for closing and opening stock. So the line is given that excess of closing inventory over opening inventory. It means closing stock is rupees 40,000 more than opening stock. Okay, closing stock ज़्यादा है किससे? ओपनिंग स्टॉक से 40,000 रुपये ज़्यादा है. तो हाउ टू सॉल्व दिस? देखो इधर. Now we know that opening stock is a positive figure in the formula and closing stock is a negative formula. So because closing stock is a negative figure and this negative figure is more, it is said that closing stock is in excess of the opening stock. Closing stock 40,000 रुपये ज़्यादा है किससे? Opening stock से. So because closing stock is more, negative figure is more, so that's why it is minus 40,000. Okay. If it is written that opening is more, then opening stock is a positive figure, so it will be, then in that case it will be plus 40,000. But right now my excess of closing stock is a negative figure, so that's why it is minus 40,000. Okay, so it's clear logic. If minus figure is more, closing is more, minus. If opening stock is more, positive figure is more, then it will be plus. Okay. So by solving this 3,20,000 minus 40, we have calculated the value of COGS, which is 2,80,000. Fine, 2,80,000. So then we can easily calculate now GP, RFO minus COGS. RFO already we calculated here 4 lakh and COGS is how much? 2,80,000. So that will give you the value of GP 1,20,000. And finally then put the formula of gross profit ratio, GP upon RFO into 100. 1,20,000 upon 4 lakh into 100, that is how much? 30%. So in this way we will be calculating this solution. Okay, this is the question, and this way we have to solve the entire question here. Now see the next question, calculate GP ratio from the information. Cash revenue from operation is 1/3 of total revenue from operation. And cash revenue from operation is given 1,40,000. So cash revenue is 1/3 of total revenue from operation and cash revenue from operation is given how much? 1,40,000. Credit purchases was 25% of, cash purchases is 25% of credit purchase and cash purchase is given how much? 50,000. Opening and closing inventories are given, and it is written that closing inventory was 10,000 more than the opening inventory, and carriage is given 12,000. Okay, so from this question now we have to calculate first total revenue from operation, that is RFO or sales. See here. Yes, now children see, cash revenue is 1/3 of total revenue from operation. Cash RFO is equal to 1/3 of total revenue, 1/3 into total RFO. So cash revenue is given in the question. See, cash revenue is given how much? Cash revenue is given 1,40,000. So cash revenue from operation I have put here 1,40,000. 1/3 of total RFO. Total RFO I don't know, so you can assume this to be X. So by cross multiplying 3 shifted to that side, that has given you the value of total revenue from operation. Okay, so it very easy. Just you have to go through the lines of the question properly. So cash RFO is 1/3 of total RFO. So cash RFO is given and 1/3 of total RFO. So that by doing the cross multiplication, we calculated the value of total RFO. Now to calculate the value of purchases. Why purchases required? Because in formula of COGS, we need what? Opening stock plus purchase plus direct expense minus closing. So that's why purchase is not given in total. So that's why we have to calculate what is the value of total purchase. So cash purchase is 25% of credit purchase and cash purchase is given 50,000. See. So cash purchase is 25% of credit purchase. Cash purchase is how much? 50,000. 25% of credit purchase. So credit purchase, by doing again the cross multiplication, I calculated the value of credit purchase. Again, it is easy to calculate. In the same way where we calculated revenue from operations, same way we have calculated credit purchase. Now total purchase is equal to what? Cash purchase plus credit purchase. So cash purchase is given 50,000. Credit purchases we calculated how much? 2 lakh. So total purchase is how much? 2,50,000. So total purchase is 2,50,000. After calculating total purchase, next part left is opening stock and closing stock. Now opening stock is 30,000 and it is said that closing stock is 10,000 more than the opening stock. So 30,000 plus 10,000, that gives you 40,000. So closing stock is how much? 40,000. Now we'll apply the formula of COGS, opening stock plus purchase plus direct expense minus closing stock. Opening stock 30,000. Purchases we calculated from here. So purchases how much? Purchases how much? 2,50,000. Direct expenses, carriage they have given you. So that carriage is your direct expense. And closing stock is given. Closing stock we calculated how much for this thing? 40,000. So cost of goods sold is how much? 2,52,000. Then from now we have both the things, RFO and COGS. So RFO minus COGS is 1,68,000. RFO we calculated from here 4,20,000 and COGS we calculated 2,52,000. So 1,68,000, and by putting the formula again we calculated the value of your gross profit ratio, that is 40%. So in this way again this kind of critical questions will be solved. Okay, clear? Go through the video once again, revise these things, understand the things, concepts properly, and then you will be able to understand the question properly. Okay. Coming to the next part of the profitability ratio, which is net profit ratio. Now all of you know what is the meaning of net profit ratio. Net profit. Net profit means the profit left after deducting operating and non-operating expenses from gross profit and adding non-operating incomes to the gross profit. That means in gross profit, if I subtract remaining operating and non-operating expenses, then and by adding non-operating incomes, we'll get what? Net profit. Higher the ratio indicates lesser indirect expense of the company. Clear logic? If the net profit ratio is high, that means company's indirect expenses are very low. And low indirect expenses indicates more profitability for the company. And that's why higher ratio indicates lesser indirect expenses of the company, which is always better. Okay, so that is net profit ratio. Now let's understand the next thing. Along with formula, certain basic things, that what is the formula of net profit ratio. So net profit ratio is net profit upon RFO into 100. Net profit upon RFO into 100. Now how to calculate net profit? Net profit is equal to gross profit minus operating expenses minus non-operating expenses and plus non-operating incomes. Now what are operating expenses? The expenses which is related to business activities like salary, then stationery expenses, selling and distribution, advertisement expenses, all these are your operating expenses. Non-operating, which is not related to your business activities, like loss on sale of assets, your interest on loans you paid, that is your non-operating expenses. And non-operating income is very easy to identify. Whatever receipts are there, like rent received, interest received, dividend received, profit on sale of assets, these all are non-operating incomes. So this is the formula, and this way we have to calculate. Let's see one question. Now in the question they have given you gross profit of a company is 20%. Now this 20% is not given, it is 20% on cost on sales. So whenever nothing is given, so this is always assumed to be on sales. Gross profit is always on sales. Okay. It's credit RFO. So credit RFO were 18 lakh and its cash RFO were 10% of the total RFO. Again, with the same thing we have to calculate. If indirect expenses of company is 50,000, calculate the net profit ratio. Okay. Now see, first of all, we have to calculate what? Revenue from operation, which is important. Now see the solution, how to solve. So the first step to calculate total RFO. Total RFO is equal to cash RFO plus credit RFO. Now total RFO is not given in question, and cash RFO is said that cash RFO is how much? It is 10% of total RFO. So 10% of the total RFO, that of X, plus credit RFO is given 18 lakh. So by solving this entire equation, we will calculate the value of your total RFO. So the value of your total RFO comes to rupees 20 lakh. Okay. See once again that total RFO is cash plus credit RFO. Total RFO is not given in the question, so assume to be X. And cash RFO is 10% of the total RFO, that is of X. So by solving this equation, we have calculated the value of what? Total RFO. Okay. Now next stage, GP is 20% of RFO. Nothing is given, so GP is 20% on total RFO. So RFO is 20 lakh and 20% of that RFO, that comes to rupees 4 lakh. So this is 4 lakh your GP. Now to calculate net profit, what we want? From net GP, we have to subtract indirect expenses. So 4 lakh GP minus indirect expenses given in the question. Indirect expenses how much? 50,000. So GP minus indirect expenses, 3,50,000 is your net profit. Fine. So by putting the formula, that net profit ratio, net profit upon RFO into 100. So net profit 3,50,000 upon 20 lakh into 100, that is 17.5%. So in this way we will solve this question. Okay. See once again. Now today's next ratio is operating ratio. This ratio analyzes the percentage of operating cost involved in sales of the company. That how much operating cost company has incurred in order to make a sales of the particular amount. Okay. So because this ratio deals with operating cost in sales, and every company wants that their operating cost, their day-to-day expenses must be lesser in the sales of the company. So that's why higher ratio indicates more operating cost and lesser profit of the company, which is not good. This situation is never good for a company. Okay, this is not good for a company. So lesser the operating ratio, better will be company's operating profit and other profits even. Okay. Now what is this operating cost? It means cost incurred for meeting day-to-day expenses of the business. Remember that operating cost is related only to the activities of the business, expenses related to the activities of the business. Now see, what are those expenses related to business? Some examples are here. That salary is given, salary given to employees of the company, selling and distribution expenses, administrative expense, discount allowed, bad debts, office expense. Why bad debts? Because bad debt is the loss due to sales only. Stationary expenses, depreciation. Depreciation is also your operating expenses, remember that. Export duty, carriage and freight outwards. Basic thing just you have to remember is the expenses must be related to your business activities. It should be related to your business. Okay, then only it will be considered as your operating expenses. If I take the example like loss on sale of car or fixed assets, that is not your operating expenses. Why? Because your day-to-day activity is not selling fixed assets. That's why. Okay. Similarly, interest paid on loans, it is also not operating because it is a finance cost. It is not related to your selling of the goods or office expenses. So that is not considered as operating expenses. That gross profit ratio of a company is 20%. It's credit revenue from operation. Now in this question, we have to calculate operating ratio for the company. Information given: net revenue from operation, that is net sales, cash revenue from operation, gross profit ratio is given. Again GP, nothing is given, so it is always GP will be assumed to be on RFO. GP will be assumed on RFO. Nothing is given, then it will be of RFO. Then next one is your office and selling expense. This is your operating expense. Depreciation, again your operating expense. Loss on sale of plant is a non-operating expense, so nothing to do in this question for this. Now first, according to the formula, the thing what we have to calculate is operating ratio. So formula for operating ratio is cost of goods sold plus operating expenses. Okay, see the formula? Cost of goods sold plus operating expenses upon RFO. So cost of goods sold and operating expenses together, this is called operating cost. Okay. So COGS is equal to what? RFO minus GP. RFO minus GP. RFO is given 8 lakh and GP is 20% of RFO. GP is 20% of RFO. So that comes after calculating GP 1,60,000, we calculated the value of COGS, which is 6,40,000. So COGS is how much? 6,40,000. Operating expenses are office and selling expenses and depreciation. See again, office and selling expense and depreciation, these two are your operating expenses. Adding these two, we have calculated the value of operating expenses, 80,000. So finally, operating ratio. Operating ratio is what? Operating ratio is COGS plus operating expenses divided by RFO. So COGS 6,40,000 plus RFO, plus operating expense 80 divided by 8 lakh into 100. So this will be giving you the value of operating ratio, which is 90%. We can say that of the total sales, 90% is your only operating cost, which is too much high and it is not good for the company. So in this way, we will calculate what? Operating ratio. So just see the formula of operating ratio. Operating cost upon RFO into 100. Operating cost is COGS plus operating expenses. Okay. So this is the formula of operating ratio. So this is the topic we studied today. Revise this and solve the questions. Thank you.